You need to off the video. Can you also pull out? Into off video there. Into off video. Off the video. Off the video.
Hey, hello everyone. Hey, this is Darren Chu here. Yeah, if y'all can hear me, please type yes so that at least I know the sound is working. Okay, good. Yes. Okay, I on my video also so y'all can see me also. Okay, but today I'm not the speaker. I'm just the host for today. Today we have invited a fund manager from Philip Capital Management to come and share with y'all Singapore dividend yield strategy. Okay. Morning, James. Actually, now supposed to be afternoon already. Okay, before I think Charles is not in yet. So before Charles is in, maybe I just, let me share you something first. Okay. Okay, for those that don't know me, before we start, this is a disclaimer. Okay, we are whatever, I think later Charles will talk about his disclaimer side. Okay. Anyway, this is just a sharing session. And as currently we're actually also on a YouTube live. Okay. So some of y'all have subscribed for our YouTube. You can actually watch us from the YouTube live also. Okay. But after that, we may remove this video from the YouTube. Okay. Okay. Just a small request. Okay. No recording and no audio recording. After the seminar, if you need any information, you can contact us directly. Okay, the Jurong East team. Okay, for those that are not aware of me, I am actually the Grace says can't hear. The rest can hear. Okay, so I think the sound and video, there's no issue in this case. Okay, please mute everyone. Okay, please also mute your own mic just in case you have been extended, unmute it. If not, because it will affect the rest will able to hear the background noise from your place. Okay, thank you for your cooperation. Okay, for those that don't know me, I was an engineer for 10 years and I come to this industry about 05, 06. Okay, then I've been in industry for about 14 years. Okay, and most of you will be aware that we have this investor center at Jurong East. Okay, this is a very first franchise in Singapore. It is called the Philip franchise, which is why we have the word light behind. This center is actually practically owned by our team that we run and operate and manage this center on our own. Okay, under the name of Philip Securities. And we open Monday to Sunday, but due to the current COVID-19, our center currently is closed, but you still can reach us through email, WhatsApp, or call us. We're just a phone call away from you. Okay, and we started with only 4 of us. Now our team has grown to close to 20 of them. Okay, for those that want to explore this industry, okay, actually MAS have a new regulation that make people able to join this industry easier. Okay, you can contact us directly and we can discuss further more on this. Okay, what we do best, what we do is do seminars. It's just what we do currently now. Sometimes we invite speaker to come and share on their ideas, on their products, or on their knowledge with our investor, rather than every time you hear us talking. Okay. We also have this Facebook page called the Well Hero Facebook page, and do support us to go and like the Facebook page. And we also have this YouTube channel called Well Hero. Okay. Currently, we are also on YouTube Live using this channel. Okay, so you can watch many of our video there. So do also support us by going and subscribe this video. And if you found that the video help you or got benefit you, do also like the video. Okay, this will able to motivate us to actually do more and create more content for every one of you. Okay, I was also on CNA. You can also see me on 958. And I'm also currently a trainer for the IBF accredited program. Okay, where I conduct courses that is actually funded by IBF. And currently I got a course called Lifetime Income Mastery, which is 95% pre-funded by IBF. Means that those that attend the course only need to pay 5% of the course fee. The other 95% are pre-funded by the IBF, actually in our it's MAS, or you call the government. Okay, this is me. I'm 14 years in this industry. Okay, and for those that are receive our broadcast, they are kind just to think note that we also have this thing called a premium broadcast by Telegram. Okay, this is for clients that are more on the active side. That means you have done at least 2 trades per month. Okay, you have done, if you have qualified but you are not invited for this Telegram, because sometimes we may miss you out. Okay, do drop us a message. Okay, then we can send you the link so that we can add you into this premium broadcasts by Telegram itself. Okay, so far that's all for me. We need to get Charles in to let him share. Anyone got any question can just put on the chat there and we'll attend to you along the way.
Hi, Darren. Hello. Hello.
Hello, yes, I'm getting chat on board. You.
Hello, Darren. Darren, can you hear me? Hi, Darren.
Okay, I think Cha is on board. Cha, can you say something to everyone?
Darren? Darren. Hello.
Hello. Oh, okay. Okay, I think Charles is actually online. I think something wrong with his site, so he can't come in. Okay. Anyway, meanwhile, before Charles come in, yeah, I can hear you. Sorry. Okay. Anyway, meanwhile, before Charles come in, okay, Charles, you are ready? We can just start. Yeah, I can hear you. Sorry. Okay. Anyway, meanwhile, before Charles come in, okay, Charles, you are ready? We can just start. Yeah, I can hear you. Sorry.
Hello. Darren?
Yes, Charles, you are ready. You can just share the screen and you can just start.
Okay. But I just want to check whether are you able to hear me clearly?
Yes, I can hear you clearly.
I'm sorry, but because I think this laptop the video is the faulty so not able to share the video.
Charles, you are ready.
Can you see the screen?
Yes.
Okay. We shall start from here. Okay. Hi everyone. My name is Charles. I'm actually from PCM, Phillip Capital Management, the fund management arm of Phillip Capital Group itself for Singapore itself. And it's been a challenging time and also a good opportunity at this point of time where a lot of things has come down, but I think we are still in the midst of the whole whole saga where we're still I mean the real economy is still going through a big restructuring. So prices are actually revising down, and also, I mean, in recent two to 3 weeks itself, we can see actually the market has actually rebounded back because of the massive the liquidity has been pumped into the market itself. Even you look at if you read into the news of the Fed decision yesterday, they still maintain the rates at almost zero. I think which is very difficult for them to go below zero, because it's going to be very detrimental if they go below zero, especially for the banking system itself. So what they can do actually now is actually to put in more and more money, to print more and more money. As you can say, they can print unlimited money into the system itself. What about Singapore itself? Singapore, basically, we are tapping into our own deep so-called deep pockets. And you can see that's why when you have a huge liquidity pump into the market itself, the market actually is reacting in a positive way to a certain extent. I hope the market is reading it correctly, but from what I got a bit of a skepticism at this point of time, because of a lot of things is not able to foresee or project until maybe the end of second quarter, towards the reporting of the second quarter and towards the midst of the third quarter. Then we'll be able to see the ugly side of the economy or coming out into the system itself. What I'm touching actually, I'm a yield focused guy. I'm always going for dividend yield. Of course, over the years, if you are long-term investors, I think yield will do you well. But of course, if you are a pure equity, you're investing in equities, there's always a equity risk that we have to subject ourselves to. But the main thing is actually when we look at equities itself, we have to follow the underlying business closely, and also I think portfolio allocation is a very important concept. I think we should adopt, especially we have a population. I mean, if you are moving to the retirement age itself, and not having everything into equities will be a good deal. Over time, if you are having a balanced portfolio, you should be doing much better compared to those who is having a pure equity portfolio itself. So you can see those balanced funds actually are doing a down single digit, and if you're just purely investing in Singapore STI itself, you're down about almost 20% year to date itself. So I'm just trying to emphasize the strategy about looking into equity yield, because equity yield will give me the sense of quality when we look at the underlying of the company itself. But no doubt, equity yield will be subjected in this kind of scenarios, in this kind of black swan event. It will be subjected to cuts, which I think if you look back GFC periods, we also have faced the kind of situation during the period. Some of the good companies will cut, but of course, in this situation, challenging times itself, everyone still have to share the burden of the restructuring the whole economy. Whether you're the government, whether you're the business owners, whether you are the share investors, we all have to share the burden in terms of dividend cuts. But when we have a cut, when we see a company is cutting the dividends, we will want to see give a sense of projections, how much will it cut and how much the prices has actually come down since the tip beginning of the year until now. So a lot of prices actually has come down and rebounded back. And all right, hold on now. So this is the overview. I'm also talking. I want to talk about a bit about the impact of Singapore from the COVID-19. So I think a lot of us is reading news every day. Since everyone is staying at home, the main things that we can only do is just to read news every day. Other than working from home itself, a lot of news is flowing. Whether is it fake or real, what I want to share is actually some of the financial stuff. how it will impact Singapore. And also I'll touch a bit on the equity yield, whether is it opportunity or is it becoming a latent risk that we are facing. And when we look at dividend yield, when we drill down deep into the underlying itself, I'm also leveraging on one of our business partners, the Morningstar. Yeah, actually, we have collaborated with them to launch our Sing Income ETF, which is a passive mandate, and it's also a rule-based, fundamental-based to create that index. So if you look at some of the key items, they're actually inbuilt into the index process methodology itself. I think it's actually quite useful and also relevant, and also what it also align with what I'm always looking at when I'm looking at dividend yield from the angle itself. So MTI revised. I think the slides is a bit outdated because I think informations are actually flowing quite fluid on a daily basis itself. Like if you look at yesterday, I think all the figures started to change. Even like MTI, the previous projection is -1% to -4%. The industry, the Minister of Industry also has projected it's going to be worse. And last night, I think even you read into Jay Powell's interview, I think he also projected that the second quarter is going to be a negative 12 to 13% the contractions in the US GDP itself. So in Singapore, I think we're also looking at high single digit contraction for the full year. Q2, I think Q1 we are doing about -2%, 2.2. It's going to be worse in Q2 when everything is shut down during this period of time. So if when everything is shut down, private consumptions also will decline drastically. I mean, what we have previously been doing, we don't spend, we still eat to a certain extent, but we don't spend lavishly as what we did over the past 5 years. You can see a lot of business will start to fail because of the consumption contractions that we are showing in this economy itself. So private consumption, if you look at it, accounts for about 36% of the GDP. And the longer we are in a so-called a lockdown scenario itself, I wouldn't want to use the word circuit breaker because I don't think it's a clear word to use. I mean, it should be a lockdown. The results in consumption is declining drastically. So what about the other aspect of the economy? When we look at our trading partners, if you can see from the table, our major trading partners is actually China. China is actually now has gradually come back from the lockdown situation, and Hong Kong actually also has came back up. Other than that, our ASEAN peers actually are in the same scenario like what we are facing right now, and same goes to our US and European counterparts. They are still in a lockdown situation itself. So trading is going to be very, very down in the first quarter, even second quarter, even the Q3 itself. So it's a lot of activities are all down. So what about the air travel? I think everyone knows about it. The airports are all almost capacity are almost reaching the 10 to 20% capacity in that sense itself. So we have built 4 terminals over the years itself to cater for the so-called the booming air travel industry in the region itself. But somehow I think we got caught in this situation. I think T5 also in the midst of building up at the same time. Everything seems air travel has totally come to a standstill. And how much will it impact the economy? I think it's going to be huge. If you look at how during the SARS period, how air travel has actually impact the departures from Changi Airport is down about from 3.5 mil all the way down to below 2 mil during the SARS period. So I think this time around, also during the SARS period, I think the air travel, the arrivals, the tourist arrival is down almost about 20% during the 2003 period. So when travel is down 20%, I think this time around, that time we don't have T4 or even like I think T3 was actually still just came online for a couple of years. With this kind of capacity, we will expect, tourism to contract even more with this kind of lockdown, with nobody coming in that sense. Of course, the flow from the tourists into the internal industries like hospitalities or even the F&Bs also will get the burn quite drastically. So even like talking about 20% down of tourist arrivals, I think it's going to be even more for this year. And if you look at the first 2 months of the 2020 itself, January is still not so bad. Previously, we're expecting about 1.5 million on average on a monthly basis to see for tourist arrivals itself. But in February, we're only seeing half of it. So it's almost about 50% drop. That's before the announcement of the lockdown itself. I think given that kind of situations, I think at least we'll see more than 60% decline in tourist arrivals for the full of this year itself. So, and how does it impact our economy itself? And you can see the tourist industry in Singapore actually accounts to about 5 to 7% of the Singapore GDP itself. And yep. So last year, I think the 2019, the full year, the tourist arrival is about 19 million. And so this year, I think we're projecting at least more than about a 60% decline in that sense. Okay. In terms of the impact of oil itself, since demand if you look at the global basis itself, demand of oil has also declined drastically, but it's still counting in terms of the decline of the demand itself. But of course, beginning of the year, the Russian and the Saudis are all still in disagreement and disputes of whether to cut or not to cut kind of thing. I think recently they come to an agreement to cut oil. That's why you can see a rebound during the March towards the end of February period itself. The oil actually rebounded quite a bit. But of course, when the demand figure starts to get when the market starts to get some clear sense as to how much the demand actually is coming offline, I think they're projecting about at least 20 million barrels per day of oil is going off. Is not in demand itself. So that's why you can see oil is coming into this is Brent crude. Has declined all the way down to about below $30 per barrel itself, and it used to be doing about 65 to 70 beginning of the year itself. And if you look at the WTI crude, recently there was also a bit of a challenging moment when the contracts for the April went into negative. I think now the May contract the May contract went to negative itself. Now the June also has declined when the month crossover itself. So there was a negative pricing in the crude oil. So everyone got so puzzled as to what is actually happening in oil itself. Everyone is how can oil become so negative? It's actually thanks to the capacity of the storage of the inventory. So on a global basis itself, I think the storage of oil is actually coming to a peak, a maximum level. At this point of time, I don't think you can find more space to store oil. When you see this kind of situation, with this kind of current supply in the market itself, oil will start to leak off in terms of the prices itself, unless we're seeing a pickup in demand. But of course, at this point of time, the longer all those developed countries are in lockdown situations, the spending or the demand of oil actually will continue to come even lower itself until we see a good sense of pickup in economic activities over the next 3 to 6 months itself. Oops. All right. Why is the oh. So what about the unemployment side of things itself? At this point of time, if you look at US is I think unemployment, the claims for unemployment benefits actually has shot up. Jobless rate actually is projected to be in the high teens. As of since the announcement of the Fed announcement itself until now, I think almost about 2 months. You can see the people getting who is unemployed has hit the most, about 25 mil at this point of time. Oh gosh, who's drawing that? Okay, and basically, how about the Singapore side of things itself? It is not going to spell a very good picture in Singapore's context itself. Even though you can see the government has actually stepped in with a lot of initiative. But over the years, I think the government has what the government has done things right in the sense that actually because of the transformation of the workers from one industry to another industries, the flexibilities in this aspect, what they're trying to do is actually to keep the working industry, the labor force in place in this kind of situation. So that's why a lot of money is being thrown to make sure that the employers are keeping the employees at this point of time. But I'm not so sure about how long will it last after this 2 months of lockdown itself. Because we are in the lockdown, a lot of things is still, businesses are still not able to get into activities in the full force itself. So crossing this June 1st itself, I think once we have, then we'll have a clearer sense as to how businesses are going to react to this situation itself. If you look at the previous, this chart itself, the GDP is quite correlated with the unemployment. You can see correlated in the sense that when GDP goes down, unemployment rate actually will shoot up. During the 03 period, you can see the SARS period, the unemployment rate, which is indicated on the yellow line itself, has so shot up to almost 5%. During the GFC period, it's not as bad in that sense because it's not a very full scale industry-wide effect on affected by the impact of the liquidity crunch during the period of time. So most of the time I think during the time the financial industry is actually more affected. So that's why you can see the unemployment rate actually is hovering around about 3 to 3.5% rate. But this time around, I think things is a bit more different. But of course, we have to factor in the impact of the packages that the government has thrown in itself. So everyone is saying it's worse than SARS. Everyone is saying it's worse than GFC itself. So we are on a base case. I think we are looking at 5% at least for unemployment rate. If you are looking at the major sectors that's affecting quite badly, first you look at the tourism market itself. I think is the big hit. The airline industry is the big hit, and then the hospitality industry is also a big hit. Same goes to F&B industry itself. So I'll call it a big hit as well. And all this actually will give us a good sense as to what it flows down into our decision making as to what we are looking at and what we are trying to avoid at this point of time in terms of our investments for our portfolio allocations towards the individual securities or stocks as well. All right. Yeah.
Charles, I think can you reshare the screen again?
Sure. I think somebody has give me a second. Give me a second. No, it's still like that. Why is that so? Somebody's drawing on it.
The drawing all clear already.
Okay, that's good. Give me a second. Okay, thank you. Okay, coming back to the unemployment rate itself. If you look at the airline industries and the hospitality industries, airline industries, if you add in all the supply chain. Can you hear me? Okay. If you add in all the supply chains, the whole value chain of the airline industries, the pilots, the aerospace side of things itself, we are looking at the total employment figures of at least more than 115,000 in that industry itself. So it's pretty drastic. You can see actually and even like if you look at the hospitality industries, it employs almost like about 50,000 people. So with hotels coming to a standstill in these 2-3 months itself, even when we see a opening of the economy itself, I don't think we're able to see a full occupancy or even the full capacity usage of the utilization of the airports itself. A lot of people is going to get unemployed in that sense. So whether I'll guess it's at least more than 50% of this group of people will have to see themselves looking for another jobs in the next 6 months later. So when you see unemployment in this kind of rate, I think it's quite drastic. Because it affects you spiral down into the economy in terms of the housing, in terms of the consumption of these individuals itself. And you can look at the 2011 to 2015, the jobless rate is about below 2%. So now it's actually before the crisis comes in. Actually, we are also facing a bit of a increase in the jobless rate. It's starting to climb up gradually. Okay. So if you look at the inflationary pressures, I think prices has become negative. But of course, we look at certain sectors which is still relevant, and this is actually based on January figures. But I think in terms of the service sector, I think it should be down in a negative position at this point of time. And food-wise, I think is still in a positive mode because everyone is still eating 3 meals a day. So the demand for groceries actually will still be intact. That's why certain companies, certain businesses during this period of time, they're very resilient. You can read in the newspaper names like Sheng Siong. They're still able to pay out additional salaries to their staff. So if you're working for Sheng Siong, I think it's a good deal. And other industries like the exchanges, the exchanges like stock markets, volume has edged up drastically during the first quarter, thanks to the increase in the volume. People used to be holding back cash and also thanks to the low interest rate, which is so pushing people into the market to take up a bit of more equity risk, given the kind of scenario that equity has corrected almost about 30% during the March period itself. So this also will give us some sense as to where we are also looking at in terms of our portfolio. All right. So what the government has actually rolled out during this whole saga itself, which is more than during the GFC periods and during the SARS period itself. So they have also stepped into the reserve. In total, I think they have rolled about 55 billion, almost amounting to about 11% of the GDP. And the drawdown from past reserve was about 17 billion. I think during the GFC period, I think it's only it's about 5 billion from the past reserve itself. So you can see the impact of this amount of money that is going to have on the economy. Some might say it's a stimulus, but what I feel is actually a more like a relief on the economy itself. When you say it's a stimulus, which means actually eventually all this money will be spent on aggressively, and that will create a lot of increases in prices in the economy. But what I felt is actually is not that case. I'll call it more like a relief to the economy itself, because when the whole contagion started itself, the businesses affected, I think we still can't project how much losses we are going to incur for the next 6 months. That's why a lot of analysts, they can't project the earnings figures for a lot of companies. You can see companies also starting to defer the announcements, the quarterly announcements towards changing the quarterly announcements towards the half-yearly announcements. And so the interesting thing is actually there are a lot of holes in the pockets of the economy itself. So what this money is actually trying to plug into these holes to make sure that to stop the bleeding to a certain extent itself. But of course, eventually, what we'll see is actually how companies will restructure themselves, and those that's not doing well, the best is actually to shut it off and to reallocate the resources to elsewhere. Especially what I see over the years, the F&B industry is actually flooded with too many resources. Okay. And coming back to the Singapore equity yield, is it an opportunity of a latent risk? If you are investing in the long term itself, we are always looking out for opportunity, whether be it a up market or be it a down market itself. But of course, in this kind of decline in huge decline in prices itself, we are seeing a lot of much attractiveness in the valuations, and but of course, the valuation also have to factor in the segment of the earnings portion itself. If we're able to project earnings, then at least we will be able to give a clearer picture whether is this company consider a discount at this point of time. But what we are seeing is actually we are only able to give a very not a very clear projection at this point of time. So of course when we trace back historically itself in terms of the PE ratio, in terms of the PB ratios, a lot of companies actually are doing way much below that those multi years of the range itself, especially during the SARS and during the GFC period itself. So when we look at the market itself, we also like to look at the yield spread between the equity yield and the long-term yield itself for the risk-free rate itself. But you can see actually the risk-free rate has been declining, also to follow in line with the US Treasuries, 10-year Treasuries itself. And also beginning of the year itself, you can see the yield curve between the 2 years, or even if you use the 3 months rate and then the 2 years rate versus the 10 years, actually the yield curve is actually a bit inverted. And this inversion of the yield curve actually has started way before, I think, last year, almost the first quarter of last year itself. We are beginning to see signs of the yield curve going to the inversion itself. So when we see a yield curve inversion, actually it gives us a sign the market will foresee a recession, at least in the next 12 to 18 months, which is quite true at this point of time. But most of the time when we see a yield curve, we do not know what is the trigger effect to trigger the whole thing. Just like during the GFC period, you can the whole thing is actually triggered by the credit crisis of the banking system itself. But this time around, actually, thanks to the COVID-19 itself, so it triggers a pandemic across the globe. And being an open economy for Singapore itself, we are affected in all ways, right? Whether your banking system also will be affected to a certain extent. So when we see a yield curve spread, if you look at 2008 itself, the spread actually increased. It goes up to, if you look at the bottom chart itself, that shows you the spread now. So it went to the high of 4.7% yield spread itself between the SDI yield curve. The yield versus the MAS 10 years government bond yield, the risk-free rate. So subsequently, when the market recovers, the bond yield actually stabilizes over the years. You can see the yield spread actually is trading like within a range itself. So that range actually was actually capped at around 2.3% over since 2011 until 2019 itself. Then subsequently, this yield spread of 2.3% actually has spiked up because the market crashes. The yield companies actually has gone up. So when yield increases, some people might feel actually it's a good opportunity to buy into this company. But the key thing is that you have to see in terms of the share price how much has declined, and then does it factor in the possibility of a dividend cuts in the market itself. So if you take the bottom equation, the expectation of the earnings, we are looking very attractive at this point of time. But the key thing is that when the actual figure comes in, it might not look so attractive after all. And of course, the second thing I'm looking at right now is actually the 10 years government bond yield. It has gone to ultra multi-year lows. We have never seen this 10 years government bond yield coming so low. It is not a good sign when we look at the long-term rates crashing down in this manner itself. So it's not a good sign for the economy that we are moving into. And of course, when we look at the S REITs, which is also a major in sectors that we are also focusing on, I think over the past 10 years, the Singapore REITs industry actually has ballooned to a very, very good size. And even to the extent that we think we are becoming one of the key Asia regional hub for S REITs. Companies, properties players wants to list their REITs. I think they will have to consider the Singapore market to list, given the fact that actually the government has actually created a good structure in terms of the regulatory framework. Even I think recently they also have announced some of the changes in the policies, like the increasing the debt, the headrooms outwards to about 50%. That actually to alleviate the pain in the REITs. So this is actually quite a good news that we are seeing from the hub. The REITs hub as a whole. Even the government is very, very reactive, proactive in that sense. So if you look at the yield spread has increased, but the yield spread actually has not increased to the extent of during the GFC period. one thing to compare is actually during the GFC period, a lot of the risks are actually quite heavily leveraged. I mean, of course, it's capped by the 30% cap ratio at the point of time. But now I think a lot of risk is actually quite able to manage the debt headroom. That's why you can see in terms of the debt capital management, I think they're doing pretty well at this point. But of course, if you look at the individual segments, some will do better, some will not do as great. In terms of the segments like hospitality, in terms of segments like retail, I don't think these two segments of the REITs will do that great in that sense. But of course, areas like people like the industrial side, I think will do slightly better. Especially if you are looking at those logistics space or even like those very thematic based like cloud computing, like Temple DC Trust itself. So you can see all these people, the share. I mean, all these REITs, the share price actually has hold up well on a year-to-date basis itself. Even like players like healthcare also has done well. Names like Power Life REITs. So. But of course, overall, this is actually the index of the FSTREI is actually the overall market risk index. So if the retails are not going to do well, we're going to see more brunt on the retail side. Then it'll be very challenging. And the government actually has come out a lot of initiative. I mean, the relief package to help all these landlords, and the landlords, I mean, in terms of the property tax relief, and the landlords, most of them actually, majority of them has passed on all this relief to the tenants itself. But that actually works out to about 1 month of their rental. You can call it 1 month rental waiver passed on to the tenants itself. But some of the bigger players like CapitaLand, like Fraser, actually has come out with more initiative, relief package for the tenants, and also that will add on another 1 month of rental waiver to the, I think on average, to the tenants itself. And on top of that, they also has released a 1 month of their security deposits. Most of the time when you rent a space itself, you have to pay at least 3 months deposit. So now they've released that 3 months, 1 month back to the tenants. So overall, I guess on an average, I think the retail tenants in Singapore will see a 3 months rental waiver. They don't need to pay rent because I think if you see these 2 months, most of the shops are all closed except for some of the F&B's names. We are still opening, but the business is actually drastically down to almost about 30%. Even you factor in the takeaway segment of that business itself. So retail is actually suffering, and if people, I mean, those players, they are heavily leveraged over the years, so they're crazily expanding over the years. Past 2 to 3 years, they will get the big brunt of this COVID-19 itself at this point of time. That's why you're reading names like Katrina, which owns Bali Thai. If you step into any of the restaurants in some of the malls, beginning of the year itself, they're reporting losses. Even like Bragthor, they're also facing a lot of situation. I mean, I think the business are also down quite drastically, and also names like Ministry of Foods. I think they're also in a very tight positions, going to a lawsuit. The banks are all calling back the loans in that sense. So you'll see more and more of these names coming online, but hopefully we're able to see some of the bigger boys are able to come in, to step in, to take up some of the spaces. But on the whole, if you see more of these names are coming offline itself, the landlord will face the situations of not able to find names in the markets to replace all this storefront itself. So occupancy rate might see some decrease in occupancy rates in the next 6 months. All right. Industrial side of things, we are still quite positive for names like those doing logistics, and even like names like Capital DC has done very well. The business actually is very resilient. in that space itself. Even like healthcare REITs, Parkway Life REITs, they are more into the elder care in Japan, and also the hospital in Singapore itself. So this industry is actually not affected in a big way at this point in time, unless you say the aged care. Some, because we are beginning to read news that some of the aged care are also affected by the COVID-19. So that's also what we are a bit worried, especially in Japan now. We are seeing more increase in the infected cases across Japan itself. So so we are following up quite closely on this situations in that sense, because especially when the clients or elderlies, that's also very challenging if any of the assets or the space are actually affected by the COVID-19. So, but overall, I think they're still, if we are able to contain it well, or prevent it well, from stay away from COVID-19, I think they are able to do pretty good, because the business model actually has become so resilient in this region. All right. So that's why when we have a yield, how do we make Singapore has become a yield focused equity market, even like overseas investors, they when they want to park the money in Singapore itself, when they look at thanks to our strength in the Sing dollar itself, and also thanks to the low interest rate environment that we have been facing over the past decade itself, a lot of clients actually are moving into equity. So equities market, of course, also thanks to the retail side, I think we're having an aging population. Our investors are getting older. The government also has to make to create a market that is more yielding light, to attract all these investors, and so to cater to our current investors in that sense. So you can see Temasek actually you need someone to lead, to create the kind of environment, to be more conducive to create a conducive landscape for Singapore equity yield market itself. So Temasek actually take the front run. The front of creating this environment by having a listed full list of companies that is paying out yield, names like DBS, Singtel, Capital Land, Capital Corp, and these are all big names. They are also has a dividend policies that is catered for the investors itself. All right, and then across the board, this is actually very broad based in terms of the financials, communications, and real estates. Of course, when we have a market, we also want to see the Singapore market as also becoming a yield segment market itself. You can look at 2010 versus 2019 itself. The dividends payout there only about 16 billion. 2019, the dividends payout is almost coming to about 30 billion. So this actually has created the environment to showcase that the Singapore equities market is actually very yield leading. All right. So if you look at the largest market capitalizations, in terms of capitalizations, actually, if you look at the 16 names of all the 700 over names in the Singapore listed companies itself, this, in terms of market capitalization, they account for almost about 50% of the market capitalization, which is also paying dividend to the investors in Singapore itself, right? So over the long term, if you're investing, reinvest your yield into the market itself, you should be able to do better than as compared to those probably not paying yield. So in terms of the long-term basis, I think you're looking at 100 almost 120% upside versus the 86% upside if you're not factoring the yield into the whole total investment. right? Of course, when we break down into the sectors itself, certain sectors will be paying better yield, and we are comparing this with the beginning of year towards the end of March this year, 23rd of March. 23rd of March is actually the trough of the market itself. So when the prices comes down drastically, the yield actually shot up. So we are also looking at different sectors to see which sector actually has seen the biggest increase in the yield itself. So we also have seen sectors like communication services, consumer discretionaries, names like financials or even like infotech actually has shot up quite a fair bit. And we are the reason why we are looking at this is also giving us a good sense as to see where is the opportunity lying, because sometimes people might say high yield is good opportunities, but of course when we see the sectors like communication services having such a high deviation in terms of the yield comparison itself, um, then we will have to drill down. Is it a U trap or is it not a U trap? And then we have to look at the underlying business. Is it resilient? If it's resilient, then I think it will become like it's not a U trap. It's like an opportunity to us to even to reallocate our funds or to rebalance our funds towards this particular sectors itself. Even like you look at utilities, actually has the lowest deviation in terms of the beginning of year prices and the March bottom itself. So actually, they have the business model actually has become so resilient, and industrial wide. So we are also seeing that kind of a good, uh, uh, not a big jump in the deviation itself. Okay, so so when we look at the individual sectors, they give us a good sense as to where we can allocate our money in this aspect itself. And in terms of the financial side, I think a lot of people might also be wondering whether is there going to be a dividend cuts in the banks itself. The banks are actually quite I mean, will be affected in various aspects. In terms of consumer spendings, I think the quality of the assets in terms of the mortgages, in terms of the corporate side, in terms of the consumer credit card sides, I think we'll see more downgrades in terms of the quality of the assets for the banks itself, and how then we will have to look back during the GFC periods whether the banks has cut dividends. So it will give us a bit of sense as to this time around where the banks cut dividends. I think during the GFC period, all three local banks actually cut dividends. You can see DBS, EPS declined 1.5 to 1.2, and then the cut in dividends about 0.73. That time, I think they cut in 2008 to about 0.68 during the 2008 period. So in OCBC, the same thing. EPS declines 66 cents per share, and then during the 08 period, they also has declined down to about 55 cents, and they cut dividends from 30 cents to 27 cents. So you can see actually the cut actually is not so drastic as compared to I mean certain companies. All right. And after subsequently over, I mean, when the market recovers, actually the economy recovers. It was quite a speedy recovery in that sense, because during the GFC period, it's actually more like financial sectors recession in that sense. So you can see the EPS actually has gone back up, even all the way to 2012 itself for OCBC. All right. And for UOB, the same thing. EPS has declined from 1.36 to 1.25, and they cut dividends from 95 cents to 65 cents. So UOB actually did a big cut during that period of time. I think also partially because of the management decisions. So that's why I can see different banks has different style of management in that sense. All right. So if you look at the corporate spread, Asia corporate spreads, during the 09 period, 08 period as well, you can see actually this is actually the headings is actually wrong. It should be the NPL ratio. This is actually the NPL ratios during the 2009 period. You can see it spikes up. For DBS, it went up to about 3%. For the two other local banks, it went up to about more than 2% and then 1.5%. And gradually over the years, I think we can see the NPL figures after the 2015 oil crisis. During the 2015, a lot of banks did a bit of write down. NPL also has came back up gradually, and 2019 you can see actually the NPL for all three local banks is hovering about 1.5%, and it can projection JP Morgan's projection actually we are looking at about 2.5 on average. So that is actually quite some time back already. I think we are also looking at least more than 3% for NPL, at least for the three local banks. Okay, corporate spread spikes. I think if you look at the 08 period, the 2011 period, you can see the recent corporate spread has actually spiked up, and because if you look at corporate spread, I think it gives us a good sense of the whether the companies in Asia are in stress or not. So since 2013, the spread actually is hovering below the 400 basis point, but now I think it's going above the 400 basis point. We're going to see more companies in more distress mode itself. But of course, thanks to the government's initiative to fund, to lend out for liquidity purpose itself. I think we are at least will alleviate some of the pain in this aspect itself in Singapore. And the widening of Asian corporate spreads does not bode well for share price performance of Singapore local banks historically, because that will flow down into the NPLs. All right. So I foresee that this time around the banks will have to cut dividends, but as to what extent, some of the banks, I think they might still want to reward shareholders in this aspect. So they might want. We are looking at the range of the GFC period. All right. So when we look at the essence of the dividend, so when we invest in dividends, we are typically why look at dividends itself? So dividends are actually funded from companies' reserve, and they grow in step with profits itself. So we can see actually when EPS grows, when operating profits grows itself, the companies is more skewed towards paying more dividends as time goes. Okay. But the key thing is always the understanding of the underlying business. Is it being challenged? Is it being disrupted in the years to come? So we can see actually a consistent evidence that dividend paying stocks significantly outperforms non-dividend paying stocks, which I showed the earlier chart. And when we pay out dividends itself, there's a commitment, more like a corporate governance check, in the sense that to align the company's interests with the shareholders' interests in the long term. All right. So when we look at understanding dividend yield itself, this is actually coming from Morningstar. There are three factors actually they are looking at: quality, financial health, and dividend yield. I think it's pretty standard, and but of course, if you they will share the so-called the recipe when we talk about quality. Financial health actually is quite standard. Everyone can do this by drawing down all the past 10, 20 years of financial history itself, and to filter up which companies is having the best financial health over the past. But of course, the key thing is always the quality on the quality side. The quality side also has, if you have, it takes a much more effort to focus on and to really drill down on the security level itself. That's why security analysis in this aspect will be needed to make a sense of what is quality and what is not quality. But this is not only at a specific point of time; it has to be followed through on a year-to-year basis. And for dividend yield itself, I think is also quite normal, in the sense when you filter up the dividend yield. That I think actually will also give you a good sense whether are you walking into a yield trap or not into a yield trap itself. All right. So with all these factors or elements, it helps you to address the dividend yield trap, especially for business quality itself. So I'll give you a very good example. That's why when we with all these factors that comes into place, these are the couple of companies that actually has floated up into the list itself. Names like which I mentioned, Sheng Siong, names like Capital DC Trust itself, Parkway Life REITs, or even names like Netlink Trust. I think I've not mentioned about Netlink Trust. All this is a year-to-date performance. I can see the green line below is actually the STI index. It's down almost about 20% year-to-date, and the rest is actually for Parkway Life REITs is about quite flat year-to-date basis, and the rest is actually on the teens of upside, 18%. I think if you look at the Samsung, I think as of today is about doing about 20% year-to-date performance. So because of the quality of the underlying business in this kind of times, if you have focus on all these qualities, then you actually help you to ride through the downside in that sense. All right, and also helps you to recover in a better way at this point of time. When you can see actually if you're down more than other people, your when you climb up that time, you'll be even harder in terms of performance. All right. For SGX, I think I missed out the name SGX. Actually, SGX has done very well in terms of the share price year to date. You can look at economic modes, one and only equities and derivatives exchange in Singapore itself. So it gives the kind of sense that it's actually a monopoly. Nobody's competing with them, but of course over the years they have they face the challenge of primary listings as compared to competitors exchange like Hong Kong exchange or even like Australia exchange itself. So in this time, I think when the volume has come back up, it's a good sign. And also over the years they actually has changed or rather build the ecosystems in a more resilient proof in that. That's why you can see during the GFC period. That's why I tracked during the GFC period, the share price of SGX actually comes down in almost the same magnitude as the market itself, STI index itself. So the question to ask is that why this time around SGX is going the other way around. So if you look at the during the GFC period, derivative accounts to less than almost about 15% of the overall business itself. So now the derivative business actually accounts to almost on par with the cash equities business. So this actually will give you a good sense that the business has become more resilient because with derivatives, when the market is down, there's two ways you can go for it, either up or down. So derivative gives you the kind of options to trade the market on the downside. So you can see when the market is down, all your CFDs, all your derivatives will do much better. And on top of that, I think they also has built the fixed income segment of the business. Also, they have also has scaled away from the primary listings by going to those passive investments. That's why recently they bought over a firm in Europe. They pay a bit of money there. But of course, I believe the cash flow is able to tie that. I mean, to clear off. This acquisition in times to come. So they're also building the passive business of things by moving into the indexing portion of the business to compete on a global map. In the lights of the BlackRock, in the lights of the Vanguard as well. All right, and Power Life REITs, I think I mentioned the quality assets, and the reason why they are quality because of the master lease structure with the operators in Japan itself. So they have about more than 30 operators in Japan doing aged care. They're very big business in Japan itself. So they have a master lease. They are not exposed to the revenue risk of all these operators. So 100% occupancy rate, even at this point of time, even moving down 6 months, I'll still foresee a 100% occupancy rate on the aged care, unless any of the assets are actually affected by the COVID-19. All right. So I think these are precautionary measures they have to take. For Keppel DC, cloud computing has grown on mid to high single digit over the past 3 years, and we're expecting this kind of growth over the next 3 years as well. So when you have especially when this time around, the whole world is actually trying out working from home. When we are trying out working from home, a lot of business will explore. Actually, working from home is not a bad idea. A lot of things will be put on cloud. A lot of information will be put on cloud. I mean, data will be put on cloud to facilitate this working from home moving forward. Good point from here. And then, but of course, if you on the high side, if you look at working from home, actually will affects the demand for office space moving forward. So that I think I'll mention a bit later. For Sheng Siong, if you see the prices of food actually is still positive in the CPI figures we have showed you just now. Among all the segments, I think prices of food actually will increase, will stay up positive in that sense. So that's why when prices of food goes up, Sheng Siong will do better. And then of course when moving forward with this kind of recession, commercial space will become relatively cheaper in terms of the prices. So you also will be a positive note for Sheng Siong when they bid for a lower price to expand the storefront in Singapore itself. And last of all, the Netlink Trust, I think if you look at Netlink Trust as a utility play itself, on the data infrastructure front, if you understand the utility segment of things itself, the transmission of electricity, actually they are quite relate. I mean, closely similar to the segment of the whole value chain of the utility segment. So they own the fiber network, but this time around it's actually the data that's being transmitted, and then they are not exposed to the end clients, which is clients like StarHub, clients like Singtel on the retail side. So they own the fiber networks. They are structured in the sense that they are under a regulated asset base payouts itself. So cash flow will be very, very stable, and all the expenses and so-called the costs will be factored in on a 5-yearly basis. So you will review on a 5-yearly basis with the regulators itself. So in terms of the volume wise, I think whether of course, as more township opens in Singapore itself, they will also benefit in that sense. All right. So this is Netlink Trust. They are quite resilient in that sense. They're paying. And if you look at all this, they're paying yield between 5 to 3% yield. All right. And one of the companies that we are seeing over the years that is not doing pretty well will be, I think I'll give a case study on SPH itself. Oops, what's that song? And SPH actually has suffered in terms of the core business, and over the years they have expanded in terms into the REIT space, in terms into the aged care, but in a small way. But in the REIT space, actually, they also are facing a kind of challenge that they have not grown. They are also competing with the big boys, the CapitaLand and Fraser. So in years to come, I think they might see more challenges. But this time around, I think they also get hit quite badly on the REIT space in terms of the retail space. Oh God, what's that? Sorry. Hold on. All right. So over the years, I think the management is pretty conservative in terms of the mindset. I think they have not aggressively expanded the other cost of business to offset the downside of the media business itself. So that's why this time around I think they suffer. But of course, over the years they have a bit of cash, which they are managing internally in terms of the investment management itself, which also has not performed that well. So this time around I think they go all out to expand into student housing. Also get affected this time around when all the students are all out of school. And Asian care, I think is something which I like, but they are not expanding in a big way in Singapore. But even though they're owning one of the largest aging care facility in Singapore, but of course they have to find the space to build new assets as time to come. As compared to Japan, in terms of the population of the aging population in Japan, I think is even much bigger than Singapore. All right, and hold on. So come back to the passive investments which we have created in 2018. I think in 2018 PCM launched the Sing Income Philip Sing Income ETF itself. It has done well. The reason why we created this ETF is actually to cater for the majority of Singaporeans who enjoys the yield itself. First of all, is tied up with Morningstar. It tracks the Morningstar, the dividend, Singapore dividend yield, the family, the range of families, the index itself. So it is paying out 4% yield at this point of time, and also they are also correct. Is also, if you compare with other similar lights of the equity indexes or even some of the mutual funds in Singapore, I mean managed by the European side of names. We have done better than the Singapore de facto index itself. If you can see from here, since the launch until now, the white line is actually the Sing Income ETF itself. The green line is actually the STI index. We have done much better in that sense. Over time, I'll expect it to do even much better because of the yield, and also because of the rule base, the fundamental rule base, which I mentioned, the three key factors earlier on. The index will reposition itself on a half-yearly basis based on this factors itself. So if there's any change in the fundamentals in terms of the debt to equity ratio, in terms of the business model itself, on a half-yearly basis, the index will rebalance itself, take out the weaker ones and then put in a stronger ones in terms of the matrix itself. So performance-wise, I think it has done, yep, at least about 6%, much better since the inception. All right. If you look at last year, we paid out about 4.1% yield, 4.7 cents payout last year. In terms of the sector allocations, as of 31st of March, financials actually is top the chart. Of course, financials is not topping the chart of financial is actually not the three local banks. I mean, actually the top one is actually SGX lah. So SGX is topping the chart for the financials, and followed by the REITs and the commercial services, communication services and industrials, and so and so and so. All right. So this is something that I think everyone should focus on, because it's, first of all, is low fees as compared to your active active peers itself. I think they're charging about 1%. This guy is actually charging 0.4% and below. All right, that depends on the overall expense ratio as well. And okay, that's 2019 lah. Yeah, correct. So the key takeaways for this time, this session actually, oops, sorry. We will, I mean, everyone, I think it's a known fact, Singapore will go into a recession, but how deep, I think after Q2, we'll see how deep we'll go into. And the speed of recovery also will take time as we unlock this circuit breaker, or what I call it, a lockdown gradually. But even if we unlock it, our airspace is actually quite constrained. Tourists will not come in. As you can see, the Singapore government has shut off Terminal 2. I think they have not decided to shut off Terminal 4 at this point of time. So in terms of the amount of people that's going to go offline, in terms of the employment rate, I think it's going to spike up quite a lot. The key thing is that when employment rate spikes up itself, how do we get these people to go to other sectors itself? But the key thing is that other sectors are also suffering. So the absorption of all this unemployment rate might not be as great as during the 2009 GFC period. So as the labor force, the longer it becomes unemployed, I think it'll be very, very tricky. If you have listened to Jerome Powell's words, I mean, everyone knows that if you're as you stay unemployed, your skills might be lost. It might become even more irrelevant. So you might not even find a job quite easily or even get the kind of pay that you used to enjoy. So your spending power will reduce. So that will spiral down into the economy moving forward. So that's a key challenge that we are facing moving forward as an economy itself. And no doubt, the dividend yield strategy has also taken a brunt in the share price, but the brunt in the share price actually will give us a kind of opportunity to look at certain sectors, whether the business is resilient. If the business is resilient, then this will give us a good sense of this segment is actually attractive to a certain level itself. All right. But most corporates are still able to sustain the yield payout given the ample cash hoard. So that's why companies like SGX, companies like Netlink Trust, they have a lot of cash. They're able to pay out, and then the cash flows are strong, and the cash flows are not challenged in this time period. So seek out companies by focusing on quality, financial health, and dividend yield. And this, if you just focus on these three aspects, I think you sustainable long-term returns you can achieve in the years to come. All right. This is the end of the session. I'm okay to take questions.
If you all have any question, you can just type on the chat box there, so that Chow will be able to see it.
Sorry, I've not seen the chat box since the start of the whole thing. So let me go through to see whether there's any questions being posed.
Okay. Like JJ Wang have posed last time, is any utility company in Singapore that's worth to consider?
Any utilities companies that's worth to consider? If you look at another name, which is the Capital Infrastructure Trust itself, I think they're also considered like a utility like to a certain extent. So I think it pays a very, very good yield at this point of time. In terms of the business model is not challenged in this downturn to a certain extent. But of course, I still like Netlink Trust. It's not considered expensive or cheap at this point of time, but at least it still gives a very, very good yield. If you're parking your money in a space that we're looking at space that is more resilient to park our money, even though it's considered a bit expensive at this point of time. Yeah. Of course, if you look overseas, I think there's a lot of utility companies we can look at. Even the Hong Kong side, names like CKI, and even like UK side names like SSE. All these are utility companies you can look at. But of course, the yield are all for UK. The yield is not. I mean, it's taxable. All right. What's the next question? Sorry.
Is it worth investing in SG or US market now?
That's the question I asked myself when I was looking at the market when they went up quite a fair bit since the bottom itself. Even like I mean the tech has done very well. I mean those people who has stayed overweight on techs, Nasdaq or even the XLK ETF itself, I think now should be in a positive mode on a year to date in terms of performance wise. I think yes, I mean all this rebound in the stock market. I call it the Wall Streets versus the Main Streets. Their over confidence. I'll say at this point of time, because given the kind of liquidity has been flow into the market, and then the Fed also has promised unlimited support to in terms of liquidity wise. But the key thing is that the country has not come to the stage where all the earnings figures are all we see ugliness in the earnings figures itself. So when you see ugliness in the earnings figures, then they will get some clear sense uh, whether the stock market is pricing the current situation, or maybe the recovery at the right price at this point of time, given the kind of rebound. I think it's more than 20% rebound since the low. From the bottom, same goes to Singapore. I think some of the stocks, I think like even like Sing Ing also has rebounded almost about 20% since the low itself. But we have not come to the stage of Q3 where we are able to project, get a clearer picture. But Singapore, of course, Singapore compared to US is a bit different. For Singapore, we can't print as much money as we want as compared to US. They can globalize their dollars across the globe itself through all those IMF. They can even lend money to all those emerging countries which they are in need of dollars now. So the more money they print, I think is like dominating the market. So it also will be good overall for dollar-based assets itself, like even to the extent of equities market. For Sing-based, I think we're trading on a very very challenging moment. That's why we're sticking to those companies that is more resilient. There's in terms of the earnings, names like which I mentioned just now. I don't see a big challenge moving forward when the economy comes online again. That's why we're also avoiding REITs. We're also quite skeptical on the retail REITs. I'm not so sure even like that 50% change in the debt structure itself. I mean the cap itself. If you increase up to 50% itself, we also want to see. I think during June, I think most of the time, most of the REITs will do half yearly revaluation on the assets itself. So on a June period, when the valuers comes in and value the assets, and most of the time when they value assets, they also look at the cash flow, the projection of the cash flow itself. So if the cash flow is not going to look great, we'll see all these assets, the valuation will going to come down. But to the extent of how much it's going to come down, I think we'll have to see after June period, and that also affects the debt to equity ratio. Even after you factor in the 50%, I think that 50% actually will help to alleviate the constraint on the debt to equity ratio, so they will not breach, at least will not breach in that sense. And then moving forward, I think the all these REITs will be able to borrow comfortably based on the debt to equity ratio. But of course, that's only a half yearly basis. But moving forward, if things don't seems to open up and more unemployment rate, consumption is going to come down and shops going to close more. I'm not going to spell very very. I'm not trying to be very very pessimistic. I mean, I'm trying to be optimistic as much as I want, but these are things I'm seeing, I'm forecasting. That is only when I reach that point of time, then will I be able to know what I say today is right or wrong. And before that, I'm avoiding all these segments until I see a positive, clearer informations that I can get from the market. All right. If you ask me whether US or Singapore, it depends also, because for US, you can see you're exposing to US dollar. The US dollar also has declined over the past 1-2 months itself. And if you don't mind the exposure in the currency wise, if you're able to hedge out the currencies, I think the US will be a better market to invest in at this point of time. I mean, given the kind of the ammunition they have in that sense, lah. But of course, for me is that I'm very very Singapore based. I'm still looking at Singapore. I mean for even for your clients who doesn't like the US dollar exposure, we still have to work within our constraints to if you're investing in Singapore long term, we're still picking up the names which I mentioned in that sense. But of course, when things starts to turn better, vaccine is being developed, and you see our airspace regionally are open up. We see travel starts to come back. Then we'll look at some of the cyclical names like airlines. All right, next. Sorry.
Okay, maybe I get one question from the YouTube side because we're also on YouTube Live. Will bond or bond fund continue to be safe?
Okay. If you notice the towards the end of March itself, all assets actually has succumbed to the kind of everyone is selling assets. There was a strong correlation between the bond, I mean the fixed income side and the equity side, and then everyone is rushing. I think institutionals are all rushing to raise liquidity in that sense. But I think also gives a very very good opportunity for people to pick up good names like investment grade names. And then, some of the fellas are all selling, then you're able to pick up. But of course, the animal between the fixed income side and the equity sides is a bit different. First of all, we are also when we invest in fixed income itself, we are looking at the cash flow, the ability to pay up the cash itself. So credit quality is also very important. So that's why we are all this while we are sticking to investment grades. I don't really like to look at high yield, and even like times like this, high yield is going to be even more challenging. So investment grades actually will do much better. But the key thing is that now you're actually picking up better pricing for investment grades, especially on the short duration side of things. You can see certain names like but of course you have to do a homework a bit more, like in that sense, to look at the books of the company and see how much outstanding debts they have, whether are they able to pay up this tranche on the maturity date that you have. Then on top of that, I think before that, I think you also have to see the underlying business, property business. Do they have other property ongoing projects that's ongoing? Is there a heavy capex that I mean a heavy maintenance capex they have to sustain itself? If they are on the yearly basis, they have a very high outflow of cash flows that they need to meet itself. Then these are things that you have to factor in, and also the interest of the existing whole series of bonds that they have issued over the years. Not just the capital market side. What about the bank loan side, in that sense? But of course, a lot of times we have not read into the covenants of the loan agreement. Some of the covenant or loan agreements, I think you can ask the investor relations or even the management itself are being challenged at this point of time. That's why I think recently the Brett Todd, I think they're having some issues on one of the covenants. So that's why it's resulting everyone is so panicking selling Brett Todd's. I think one of the issues itself. So whether fixed income, if you are a balance, you have a balanced portfolio itself, we still want to invest in fixed income in that sense itself. But of course, equity markets has come down quite substantially. I think during the March period, a lot of balance managers, they have actually rebalanced, and whether are we going to skew more towards? I'm talking about from the Singapore context itself, not a global context itself. Whether do you want to skew more towards equities at this point of time, and you used to have a 60-40. Maybe now you might want to increase it to a 70-30, or even to the extent of 80-20. Also depends on the individual risk profile of the investors itself. Fixed income, we are also picking up a lot of good names. At a cheaper price now, so we are gradually able to pick it up at this point of time. Investing,
we'll have to wait to see the second quarters when the results all I mean the GDP figures comes out, and then we will want to see whether we want to overweight on equities. But of course, it's very clear that the vaccine we'll see more light on the vaccine development towards the second half of this year itself. So, but of course, you'll be more draggy on the economy. A lot of bad news will still comes out in that sense. So I think when the bad news comes out, the prices will correct a bit. Then we will start to pick up the names. We'll not want to pick up on the equity side at this point of time, because I think the prices has gone up quite a fair bit.
Okay, maybe we have 3 more questions. Okay, one question actually there's a question about the Sing Income ETF. I just brought up. What are the fees involved, and can we use CPF to invest? And where can we find more info on this ETF?
You can go to our website, the Philip Funds, our PCM website, philipfunds.com. And if not, then maybe we can send you the fact sheet. We have a recent fact sheet that has been. If not, then you go to the SGX website. I think they have the link there. A lot of information is being published there in that sense. In terms of fees, is pretty clear cut. I think management fees and also the custodian fees, all these are pretty minimal, but I think the main chunk is still the management fees, which is about 0.4%, if I get it correctly, 0.4%. So if you compare with your other active managers itself, like, I'm sure you should know the names, the A name and the S name itself, they're paying at least about 1% to 1.5% in terms of management fees. So we are performing better, and then the index, we're also charging lesser than most of the active managers itself. So I think over the long term, with this kind of lower fees, you should be able to perform much better in a sense. All right. So next question.
Okay, you get one from the YouTube side. What is your opinion on the recovery of SIA after build up?
Opinion of SIA. I guess it's currently just to sustain the cash flow of SIA itself. It also depends on because SIA is a global airline itself. You can see that it's flying to a lot of countries, and for sure, no matter what, under any situation, the government will definitely bail out SIA in that sense, but of course, you compare the likes of the Virgin Airlines. I think they are all privately invested. Even like if those privately invested names, I think they might not get so lucky in the sense that they have a government support in that. That's why you can see the Richard Branson is also selling off the airline. But where will we see light in Singapore Airlines itself? A lot of planes are all parking in the parking lot right now. They're not flying itself. So a lot of costs are involved on a daily basis. And these planes, as long as they're parked there, they're not flying, depreciation will still comes into play itself. So we'll see more money. Hopefully we'll see more money. But the source of money was, to a certain extent, will be coming in from the government to a certain extent. And if you ask me whether can we buy SIA at this point of time, I wouldn't. That's why I want to stay clear of all these sectors and industry at this point of time, and until we see the whole world comes into a normal life again. Until that, I don't think I want to touch SIA, even though they say they pay up. They're taking out more debt. In terms of cash flow wise, I don't see the cash flow coming in, at least for the next 1 year. All right.
Okay. One last question. Also, just now what you mentioned about Temasek Holding Company. Will Temasek still invest in Keppel at $7.35 by October?
Wow. Sorry, what was the question again? Will Temasek invest in?
Well, Temasek will still invest in with capital at $7.35 by October, because Temasek have actually made a point that they will buy over 50% of capital share at October this year at $7.35. But I think there's some perform criteria they set for capital call.
I didn't follow the details of the whole deal, so I'm not able to give you some clear sense as to whether we did buy at 735. In that sense, hold on, give me a second. I'm not so sure about the conditions, but of course, if you look at the share price now at almost about $6 or so, buying at 735 would be quite silly, right? Isn't it? So that's why we have to follow through with the management to see whether this deal is going to go through again. If not, they will have to revise down the pricing of the deal in that sense. But of course, for sure is that 735 is not is a big discount compared to the prices now. Yeah. Then of course the Temasek board, I think they also have to see whether they have to go through. I mean the investment have to go through the board in the sense that if they want to stick to the price, then it's not feasible. Maybe they have to restructure the whole deal again. Yep.
Okay, I think that's good enough for today. I think let's thanks Charles for sharing his time with us. Okay, if you all have any question or anything about this Sing Income ETF, we can just WhatsApp to our team phone. Okay, we'll try to help to answer you some of the question. Okay, if not, we thanks Charles for his time. Charles, thank you.
Thank you very much. Thank you very much.
But before we all go, maybe give me 5 minutes to wrap up the session. Okay, thank you everyone for staying through this session. Okay, if you want, we'll try to going forward. We'll try to invite some other speakers from maybe some fund houses or fund managers to come and share with y'all anything. But if you can just give us some suggestion along the way, so that we will know what y'all would like to listen, especially during this circuit breaker period. We can actually try to invite more speakers to come along the session. Okay. And for those that any other question, you can just WhatsApp to our team phone. Okay. On any question regarding this Sing Income ETF matters. Okay. We are able to share you more information on this also. Okay. Yeah, been around for a few years, and actually look at the track record. Actually, it outperformed the STI ETF. Okay. In terms of price and also in terms of dividends in both aspects. Okay. I think a lot of you are also aware that I'm actually running a course called Lifetime Income Mastery course. Okay, it is an IBF approved course. Actually, the main course objective is for people to want to plan to build a multi-asset passive income portfolio for themselves. Okay, this course is started in, I think I conducted this course since 2017, but last year October it got approved by IBF and it became the one and only so-called multi-asset retirement planning course in Singapore that's funded by IBF. Okay, and for this April period, there's some changes because due to COVID-19, government have made some changes to this course structure itself. Maybe I share with you about this. Okay, it's fully conducted by me. It's a 2 full-day course. Okay, and the first part of this course actually talk about your personal finance aspect. Before you want to do any planning or want to invest, you need to know whether you got money or not. Okay, so this is to help you to check your personal finance aspect. Okay, maximize your CPF return and grow on your SRS portion. Okay, this is what the main part is to cover. That means you need to check where's all your leakages on your investment. Okay, and so that you got more money to invest. Okay, the next part of the course actually is the main component of the course is to look into analysis on bonds, REIT stocks, unit trust, and also look at the guarantee portion to see how can you build a multi-asset portfolio. Actually, this course is to help you to create actually a watch list okay, or what you can buy from the market, what risks you can buy, and what stocks you can buy, and what unit trust you can buy, and how we analyze it and how we view it. Because for us, we also do portfolio management for our client. So actually we are sharing you how we decide what stock to buy and what risk to buy. We share you our analysis methodology, and you can apply on your own aspect. Okay, and after you have done all this, then is the last part where you want to build your passive income portfolio for your retirement portion. Actually, we talk about two main parts. One is something we call a paycheck. There's something to guarantee you no matter what happens, especially at current market juncture. If you are being unemployed or economy downturn, you still got stable stream of income. We call it a paycheck that guarantee you to able to pay for your bill, pay for your food, pay for your transport. Okay, then the next portion of the income you want to look at is mainly on the investment income. They're able to pay you. We call it a play check, so that when good time, you got more cash flow, you can go for a good holiday, go for fine dining. When there's a bad time, you still got certain form of income that come in, and you may able to use it to capitalize on the market. Okay, so this is what this course is all about. It's a holistic way of having to plan for your retirement aspect. And after the 2 full day, okay, we have one more revision class, because some of you may not able to grab some of the concept well, or may have missed some part during the session. We have a revision class just to review, recap, and reinforce your knowledge on the skill you have acquired during a full day workshop. Okay, as this is not a theory class, this is a hands-on workshop. You are supposed to do your own planning, do your exercise, and you are supposed to come up with your own portfolio. Okay, your own portfolio. And we have a 2 session of one-to-one session that we will go through your portfolio with you, and we will give you our view on it and how can you fine-tune and even better your portfolio so that you can get better income along the way. Okay, and it's not only this. After that, well, I'll give you all the tools for you to share on it. Okay, on this, how you can plan your workshop. And most important is after the workshop, we still got ongoing support system that we'll share with you what are the market update. And there's only a graduate only seminar and webinar that we only invited those that attended the course to come for this session. I have done that 2 weeks ago. We talk about what are the fund, what are the stocks, what are the US stocks you should look at during this period, and how to build a portfolio to weather through this current market situation. So this will be a 6-month support ongoing. Okay, the value of this course actually is 4,002, and we get it approved by IBF in October, which why this called introductory price at 1,284 only. Okay, do take note, it's called introductory price because it just started in October last year, and the price will definitely going to change. Okay, because due to the COVID-19 thing, the government have changed the rule of the funding for this course. In the past, it is 70% and 90% funding based on your age. Now is as long as you are Singaporean or Singapore PR, okay, 95% of the course fee is pre-funded by IBF. The government pay for you first. Okay, government pay for you the course fee. Okay, you only need to come up 5% of the balance. Okay, which actually is only $62.20. And if you have your previous skill future credit that you have not used, you can use that skill future credit to offset the 5%. Okay, the coming skill future credit is not in yet, so you can't use that. Okay, but you don't have the skill future credit, then you need to pay the cash. So the capital outlay is 64.20. And I think Singapore government have done something that a lot of countries didn't do, that is on top they pre-fund for your cost, they also pay you when they attend the training. Okay, I think this is 2000, the government had do similar thing, but they didn't do this thing. Okay, that means that if you attend, finish the course, complete the course, they'll pay you $160, which is equivalent to $10 per hour for attending the course to upgrade yourself. Okay, where can you find such deal that government give you money to ask you to go and upgrade yourself? Okay, they'll pay $160 after complete. They pay directly to your bank account. They don't give you a check. You need to pay now, tie your NIC. They'll pay direct to your bank account. Okay, after you complete the course. So this is these are the question. Okay, your question you can ask me later. What are the prerequisites to attend the course? Okay, this is there's the prerequisite is first thing that you must have a laptop. Okay, because you need to do your own planning, you need to do a research, so you must have a laptop, and you must know how to use Microsoft Excel. Okay, that's a basic function you need to know. Okay, because we don't make it to become a computer class that we teach you how to surf the net, teach how to use Excel. You must have this understanding of how to use it. Okay, and is it difficult to claim for IBF in the past? Before April is after you must pay the cost fee first, then you claim. Now is they pay upfront for you, so there's nothing for you to claim for IBF in that aspect. Okay, it's a training company will go and settle with the IBF on this process. Okay, will the price be the same in future? Definitely no. The price will definitely go up in future. Okay, can I sign another date? Yes, provided there's other date for you to sign up because the May class already full. Okay, and we are closing some of the date very soon. What if you cannot attend that day? If you already sign up and that day you cannot attend, need to just let us know. Then we'll reschedule you to another date. Okay, when there's vacancy. Okay, but don't try not to tell us on the last minute unless you are sick on that day. Okay, do I need to bring laptop? Yes, definitely you need a laptop. If not, you can't go through the course. Any subscription fee? Okay, this course there is no subscription fee you need to pay after the course. Okay, there's no data for you to subscribe. Okay, you don't need to pay any license fee. Whatever information I will teach you along in the class is get for free. You're able to access all the data for free. Okay, I will share with you where is all the free source. Okay, is there any upselling of another course after the workshop? I only run one course, which is this course called Lifetime Income Mastery. Last year, I ran a course called the REIT Mastery. After my baby is born, I told CyberCode I'm not going to conduct other course. So I only have this course. So after this course, I got no other course to sell you. Okay. So just reassure there's no upselling after the session. Okay, what you never sign up, then you'll be as per life will just go on as for both of us. Okay. Just remember to say hi to us, and our client you can always seek us for financial advice. Okay. This is the summary of this course. Okay. If you want to know more about this course, just scan this QR code. We'll lead you to a website. We'll give you more detail on the course site. Okay. The course fee is 1284, and if you are Singaporean PR and if you don't have a skill future credit, you just need to pay $64.20. Okay, if you have skill future credit, you can use that to offset it. Okay, that means it becomes cashless for you. After you finish the course, the government pay $160. Okay, the May one is already full. Okay, we only left the June and July one, and the June one, I think by next week you'll be closed for subscription already. Because the sign up rate is very fast during this period. So you got any question, you can just ask me. Okay, if not, I thank everyone for attending this session. Okay, if not, thank you everybody. Anyone got any question, you can just WhatsApp to us. You can WhatsApp to our team or phone. The number is below, or you can send an email to Jurong East. Okay, you want to know more information, just scan on the QR code. Thank you so much. Okay, Young as such, where is the classroom class? The classroom class will be at the Raffles Place area. Okay, will be in town area at Raffles Place area. At Raffles City, but we'll see that at the point in time we look at if there's not enough space, we'll move another area, but it will definitely be in town area. Okay, will not be in Jurong East. Okay, there's a question asked. Do you need to need to apply IBF? We no need to apply for IBF. Okay. The organizing company will settle with IBF directly. Okay. What you need to do is only to pay the 6420 if you don't have a scale future credit. Okay. Robin asked, can the classroom lesson be conducted online? Currently, our class is conducted online. For example, next Monday, we have a class that's online. Okay, it's already full. And we have another one in May is online. Okay. The June one, currently we put on a classroom basis because the circuit breaker is supposed to end on 1st of June. We'll only know it whether we may need to shift it online or not will depend on the market situation. We'll keep those informed. That's for those that already sign up for the June and expect to be on a classroom basis. We actually will reschedule to a later date for those that for the classroom. But for those that are okay to go online, we'll go online and expect.